Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for March 8th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning, gentlemen.
Good morning.
Good morning.
How's it going?
Pretty good. Pretty good for pothole season. We got
pothole season.
it's thawing. Things are thawing rapidly in the New England area, which means all the potholes are opening up before we get into construction season fully.
Same here. And all that trash that melted out of the snowbanks is blowing up against the berms on the highway.
I found an Amazon package buried under a 6-foot pile of snow yesterday. I'd been wondering.
Was it something you ordered?
Yeah, it was. But I ordered so much stuff, I'd forgotten what I'd ordered. So,
welcome to my world.
Yeah.
Well, we're here every week at 10 a.m. Eastern on Tuesdays talking about the freight market, things that we're seeing, but most importantly, answering your questions. So if you have any questions, please drop those in the chat or comment section below. We will get to those at the end of the show. So with that, I am going to turn it over, to myself, I guess, to talk about our key trends of the week. Right. So we're starting to see signs of seasonality, especially with dry van and reefer. I think there's some interesting things happening in flatbed due to energy prices as well as housing, which Dean will talk about in more detail. We have contract rates continuing to plod up. Again, we've talked about numerous times on the show that contract rates going up lowers more capacity over to the contract side of the house, which then in turn drives spot rates down. The big story, which we're going to spend most of today talking about, is diesel and energy prices in general. This is the 2-year anniversary of the pandemic. And then daylight savings time. Try not to lose too much sleep over it. Tell that to anyone with kids, who will be an absolute beast on Sunday morning. With that, I'll turn it over to Dean to walk us through the market update.
Thanks, Ken. Let's dive straight into it. We've got a lot to cover at the end of the show. So let's talk about the load-to-truck ratio and dry van. Market continues to cool, as Ken mentioned. Volumes in the load post section dropped for the 4th week in a row, now down 17%. Below this time last year. More carriers came back to the market last week, so capacity loosened slightly. As a result of those two movements, we've got a load-to-truck ratio just dropping about 10% to 5.88 last week. It's about the same level as where the polar vortex was this time last year after its impact started to move out of the market. So definitely a lot of seasonality in that particular number. In the reefer sector, volumes have dropped 24% in the last 4 weeks. They're about half the volume they were at the start of this year, which is a significant drop. Load post volumes are also about 21% lower than the previous year. Load to truck ratio dropped slightly to 11.03 loads per truck. And in flatbed, no surprise, of course, as we get into the spring and seasonal surge in building and construction activity, flatbed market's tracking very closely with 2018 and last year. We've moved past the 100 loads per truck mark, a level only observed just 2 weeks in each of those prior years. Equipment posts have dropped as a result. Capacity is tightening. Load to truck ratio ended the week at 103.47. Make sure you download our weekly market update this week, which will be out Wednesday evening. We've got market expert Dustin Jalbert from the Fast Markets organization. He's talking about the building and construction industry in 2022. It's a great read. Don't miss it. It'll be published Wednesday evening. Having a look at the market condition index for dry van, capacity tightened in the southeast last week, especially around the Florida Panhandle. Miami, it was particularly tight. Load volumes jumped 13%, rates up to $1.27, only up 7 cents a mile. But there's definitely upward movement there as we head into produce season. Similar rise in outbound rates in Jacksonville. Spot rates averaged $2.08 per mile. That's excluding fuel. Loads to Philly were down 11 cents a mile, though, to an average of $2.28. Charleston, lots of port congestion and delays there with the some of the bad weather they've had and the influx of ships that have been avoiding the West Coast. Congestion has pushed more volume into the truckload market. Load post volumes are up 13%. Outbound rates are only up 2 cents, averaging $2.92. That's significant. They've been dropping for the 3 weeks prior, so capacity tightening there in Charleston. In Chicago, capacity continues to tighten. They've had 3 weeks of successive rate gains. Rates are up another 2 cents a mile last week to $3.43. On the West Coast, spot rates in the busiest warehouse market lane in the country between Los Angeles and Stockton, rates jumped 47 cents a mile to an average of $4.46, excluding fuel. Having a quick look at the refrigerated market, Lakeland, Florida, That's where the Strawberry Festival is on right now in Lakeland, celebrating the strawberry season. Capacity tightened slightly. Rates are moving up past the $2 a mile mark. They've been there for about 3 weeks, so they'll start to take off shortly. Again, no surprise there. It's produce season in South Florida. Lakeland to Baltimore, volumes were up 14%. Spot rates went in the opposite direction, though, so plenty of capacity northbound on that lane. For brokers and shippers, rates dropped 12 cents a mile. It was a familiar story across a lot of refrigerated markets last week. Volumes up, rates down. Same thing on loads to Chicago out of Lakeland, Florida. Loads moved were up 17%, rates down to 176. Similar trend on the West Coast. In Ontario to Phoenix is a pretty busy lane for reefers. Volumes are up 11%, rates down 34 cents to an average of 405. So capacity loosening substantially there on the West Coast. And on the Las Vegas lane out of Los Angeles, after dropping almost $1 a mile since the start of the year, they did stabilize this week at 523, still 80 cents a mile higher than this time last year. And wrapping up our market condition index with flatbed, very similar trend. Flat capacity was tight in Lakeland, Florida also. Rates jumped 18 cents a mile to 224. In our largest flatbed market, Houston, rates increased 9 cents a mile last week to an average of 285, and as high as 329 on the number one lane for loads moved between Houston and Fort Worth, Texas. Out on the West Coast in Los Angeles, flatbed capacity was very tight for loads to Phoenix. Rates increased 2 cents a mile to 389. Following a 12% week-over-week increase in loads moved. And following a week of torrential rain up in Ned's part of the world in the Pacific Northwest, spot rates in Medford jumped 56 cents a mile to an average outbound rate of 381. So wrapping up our market update with our year-over-year look at spot rates. As Ken mentioned, spot rates continue to exhibit signs of seasonality, decreasing, albeit very slowly. Last week, the national average dry van rate decreased really by less than 0.5%, relatively flat in general terms at 265. It's down 7 cents a mile in the last 4 weeks, still 40 cents a mile higher than this time last year. In the refrigerated market, tracking very closely with the dry van sector, still very flat. Rates ended the week at 298, still 36 cents a mile higher than this time last year. And in flatbed, the story was the reverse. Rates increased another 2 cents a mile last week to an average of 270. That's just 4 cents per mile below the record high of 275 recorded last year in June. Rates are now 39 cents a mile higher than this time last year and about 55 cents a mile higher than this week in 2018. So that's it for the market update. Remember, drop into the DAT.com website, go to /market update and download our weekly report. And that's it. Over to you, Ned, for the short-term forecast.
Hello, everybody. Before we get too much into the short-term forecast, I want to caveat 2 things. Number one, the model that I've built does not, or none of the models that I built take into account geopolitics. So we're just going to put that off to one side, and this is assuming that things are more or less stable from a broad perspective. The second thing is that these forecasts are excluding fuel. So just keep that in mind as we go through. We're going to begin with our dry van forecast. You can see in blue the market rate observed by DAT, and then off to the right you can see our different forecasts. In red, the short-term forecast is a little bit bearish, expecting a drop of about 15, it looks like to me, cents over the next month. I think that's maybe a little excessive. In green, the ratecast model is expecting a drop of 5 cents before a rebound back up to about current levels in the later part of March. And in gold and silver, our blended forecasts, which are mixtures of the 2 forecasts in different amounts and in different ways, are leaning more towards the short-term forecast, although they do have a little bit less bearishness to them. Now moving on to the reefer. Once again, in blue, you can see the market rates observed by DAT. And then off to the right, you can see our forecast. Here, I think the short term is very, very much too bearish. This is predicting a drop of about 50 cents over the next month. I really don't see that happening. Our our ratecast forecast, which I think is a lot more stable and less prone to these kind of wild overreactions, is expecting rates to stay at about current levels, maybe dropping by a couple of pennies before lifting back up into the later part of March. Finally, the blended forecasts in gold and silver are expecting a drop that's still pretty substantial. Looks like about 40 cents, 35 cents from here over the next month before hopefully having a little bit of a lift after that. Finally, moving into flatbed, you can see the blue, the market rates observed by DAT. And then off to the right, in contrast to the others, there's pretty broad model agreement that rates are likely to go up by about 10 cents over the next month. Red is our short-term model, is the most bearish out of all of them. Green, our ratecast model, has a little bit more shape to it, where it's expecting a little bit of a flat for the next week or so before a rise and then flattening back out into the later part of March. And then the blended forecasts are right in the middle between the two forecasts. And with that, we're on to our IQ question of the week, which is, what are some tips to help mitigate the impact of rising energy prices?
Yeah, very topical.
Yeah.
Do you want me to kick off, guys, with sort of what my take is on?
Please, yes.
Yeah, I mean, clearly historic levels of increase. Yesterday's EIA ULSD price nationally, the national average was $4.85, call it. It's the highest in history. The series only goes back to 1990, early 90s. I think it was 94. The previous high in terms of weekly average diesel price was $4.76 back in 2008 during the Great Recession. So this is sort of extraordinary numbers. The only time, I mean, that the rate increase yesterday of about 74.5 cents was double what we saw back when we had that big sort of double whammy from Hurricanes Katrina and Rita back in 2005. So just extraordinary numbers. I had a look at the EIA data today. Diesel prices are up 90 cents a gallon in the last month, $1.71 in the last year, and almost double where they were in November 2020. You'll remember that diesel prices dropped after the pandemic took hold and stayed relatively flat at about $2.44, I think, all the way through November. And they've been on the rise ever since then. So they've almost doubled since then. Just extraordinary numbers. Of course, spot rates are up. Carriers have had pretty good profits up until inflation started to force up a lot of their operating costs. If I look at the fuel as a percentage of revenue using current spot rates, we're up around 31%. That's extraordinarily high. Long-term, not unprofitable at those levels. So carriers need to be really careful about what they do. Some of the things that carriers can do, are somewhat obvious. I'll ignore all of the, aerodynamic savings that carriers have probably done over the years in terms of, skirts under trailers and pop-out, trailer tails to reduce the vortex at the back. The main things that carriers can do, weight's obviously a big one. Aerodynamic drag is probably the biggest one. Most of the wind resistance accounts for all of the energy that a truck loses at highway speed. So tire rolling resistance, I think based on my experience over a couple of million miles, the biggest thing's speed. And this is an interesting discussion because a truck traveling at 75 miles an hour burns about 20% more fuel than one going 65. The challenge is in the US, there's 16 states where you can legally run 75 and 13 states where you can legally run 70. But there is an opportunity cost for slowing down with spot rates so high. Everybody's out rushing. You see a lot of drivers out there rushing, trying to make as many miles as they can before they run out of hours of service. General rule of thumb, for every mile an hour above 50 miles an hour, fuel mileage decreases by 0.1. But I'd just like to expand on a couple of things. Idling is a big one. You use about a gallon per hour. Over a 10-hour break, that's 10 gallons. At $4.85, that's $50 a day. That's about $12,000 a year just in idling costs alone. An APU will only run about $2,000 a year in terms of operating costs. The ROI on an APU is about 10 months. So APUs are a really good way to get ahead of the fuel curve there. But on the speed one, if you go from 65 to 75 miles an hour, over the course of the year, you'll burn about $4,000 more in fuel. 4,000 gallons in fuel. That's about $20,000. So 10 miles an hour more, 65 to 75, you're burning about $20,000 or more. But at 75 miles an hour, you're an hour ahead of the curve. You save an hour in terms of trip time, and you're not breaking the speed limit in those states where you can do it, of course. So the opportunity cost of that hour by driving slower is about $122 an hour. That opportunity cost by not being productive for that extra hour is about 30 grand a year. So the net is that with rates so high, and this has always been the case, the cost of the fuel is far outweighed by the amount of money you make from the extra speed. And I'm not talking about breaking the speed limit. I'm just talking about getting more miles into each hour. And that's the key when it comes to profitability, is miles in each hour, not miles per hour. So it's an interesting one. Speed's the big one. Idling, I would say, is a really easy one for drivers to get their head around right now. Tyres are another one. Driver training's a huge one. The ATA estimate that driver training's as much as 35% in terms of the improvement gains when it comes to less skilled drivers. Training drivers in how to drive differently or better, more efficiently, can generate some big changes. So training, tyres, speed. I'd be working on idling more than anything right now. A lot of drivers idle, particularly this time of the year when it's not as hot. It'd be a good time to be saving some money. So that's my take on it, guys. Fuel's about 44% of operating costs right now. It's extraordinarily high. We haven't seen anything like this for years.
Yeah.
So I think that's great from a carrier perspective. If you're a broker, so if you're a shipper, let's take the easy one out right first. You typically have a fuel surcharge, right? So my guess is that your financial planning to start the year had some sort of economic forecast for what the EIA diesel would be. You use that to plug into your fuel model and project out what your fuel costs would be. Obviously with fuel changing, that's going to go up, but it's all based on a set scale. I think the more important thing to focus on is spot freight you're moving as a shipper, but most importantly, spot freight as a broker on the capacity side. So typically what you're getting is all-in pricing, right? And I know in a lot of times what you're giving your shippers is all-in, especially ones you don't have a contractual relationship with, where you'd have a fuel scale. So what tends to happen there is as fuel prices go up on the spot market, it tends to deflate the portion of it that's base. And you might think, well, who cares? The all-in price is the all-in price. Well, let's just walk through a scenario where fuel goes up. Let's just say the fuel surcharge allocation of your all-in price. So you have a $1,000 load, fuel goes up to the equivalent of, let's just say, $200. Well, you might not be able to get your shipper to pay that full $200 more in such a short amount of time. So you may only get $50 to $100. Let's keep the math simple. So it's $100. So the price is $1,100, but in reality, based on the change in fuel, that's costing you as a carrier $200 more. So in theory, you're making $100 less. The average base price for you went down $100. So what happens when fuel goes back down, right? Let's just say we open up the strategic reserves, fracking, all that stuff happens, the oil goes back down, and fuel prices go back down to where they were. There's no mechanism to write where that base is. So that base that lost $100 is pretty much gone until there's a market dynamic to bring that back up. So if fuel goes down that $200, all of a sudden we're at $900. We went from $1,100 to $900, right? So this is how fuel can, rapidly rising fuel prices can put deflationary pressure on base rates. And when it goes away, it sort of leaves this erosion, if you will, of the underlying base rate structure. So it's just something to keep in mind. It happened in the end of 2018. It's happened in 2014. This is a known phenomena that really can impact you if you're not paying attention.
Yeah. Especially the spot market carriers, right, Ken? It's a little bit different for the contract carriers, right? Because they can buy fuel more closer to rack, if not at rack, and they can hedge against their rising fuel costs in particular.
Sure. And I think, too, that they'll typically have a fuel scale in place, right? And I know it doesn't recoup everything. I know as fuel goes up, you recoup a lower percentage of your actual operating costs. But yeah, I mean, it's something to think about. If you're a broker, I remember this all too. So you're typically reporting all-in prices. I mean, your revenue might look fantastic, but keep in mind that a lot of that is being passed directly through to your carriers in terms of fuel. It could throw off your PT percentages, things like that.
Yeah, there's lots of talking to some drivers yesterday. They're paying for it every day at the pump. Some drivers are paying $6.06, $6.10 per gallon out in California. Prices are extraordinarily high there. Rates are sort of cooling off a little bit, but they're carrying that cash flow until they get paid. And some of those smaller fleets that aren't factoring, they're carrying their debtors for up to 30 days. It's a huge cash flow challenge for fleets that are spending a lot more money on fuel than they would have normally. So it's this is a really difficult time for a lot of carriers, especially those that on the smaller side that have joined the industry that don't have a good handle on their operating costs. This is going to be a difficult few months until this settles down, assuming it does in that period.
Ned, we don't forecast fuel, right?
We do not forecast fuel. We leave that to the people whose job is forecasting fuel.
Or the government, right? One of the reasons we don't do this is the EIA provides a fuel forecast. And, I mean, much like the government's ability to keep the roads free of potholes, I don't know how much trust I'd put in that fuel forecast, but you could kind of take that fuel forecast, superimpose it on top of your fuel surcharge program if you have one, and then sort of see where that's going to lay out. No forecast is going to catch what was it, Dean, 74-cent week over week spike?
Correct. Yeah. Yep. That's caught a lot of people by surprise. Well, hopefully we'll have a guest on next week to dig a little bit deeper into this. So working on an industry expert to come on the show and chat about this particular subject.
I mean, this is one of the very few things we've been talking about that could dislodge spot rates from where they are.
Right.
At the moment. You know, especially within reefers, we're starting to see that cresting pattern. I mean, they're coming down. The question will be how far they fall before the kind of catch as we head into produce season. Dry vans, we haven't seen nearly the fall off we would expect seasonally, but it's definitely trending in a downward direction. So, I mean, it's a precarious position, especially as interest rates start to go up, because, I mean, that's going to have kind of confounding impacts on capacity, where it's going to be more expensive to buy a truck. Right, but it could help inflate spot rates to make it more lucrative to run a truck. So, you know, it's...
One friend of mine said yesterday he's been running at about $340 to $350 a mile all in rate. So he's been doing pretty well in the last year. And I said, so what's your plan? He said, I'm going to stay home. He said, I've had a great year. I'm just not going to drive. And I thought, well, that's an interesting take, because the drivers have had a pretty good year. They do have the luxury to be able to do that. So we could see some tightening capacity as some drivers elect to shorten their length of haul, shorten their trips, stay closer to home, not burn as much fuel, be more cognizant about deadhead miles, be more selective about what they do in terms of their trip planning. I think that's probably something that we help in particular with, is the route optimization and through the spot market, is being able to minimize deadhead miles in particular.
Yeah, we're actually doing a big sustainability study. I'm going to tease that a little bit right now about kind of like the reduction in empty miles that you're able to kind of tease out from the load board, and how it. And Ned did this fascinating click study. What was it, Ned? You want to hit that real quick?
Yeah, that was actually really interesting. So talking post 2019, about every 2 clicks on the load board translates into 1 load move, more or less. And it's not completely stable, but it's stable enough.
Which is interesting, right? Because if I'm shopping for a new power saw or a new coffee grinder, I definitely click on more than 2 or 3 brands or models. But I mean, I would have expected that number to be astronomically higher.
No, I completely agree. But I think that it's, I mean, not to go too deep into the data nerdery here, but I think that there's like 2 factors. Is that not every load moves on the load board. And so because not every load moves on the load board, we see those loads in our submissions data, but we don't see those loads on the load board. And so those show up as like 0-click loads. And then on the converse, we have some number of loads that are overrepresented, where the same physical object will be posted more than once. And not to keep harping on the horn, or that's a really bad mixed analogy, but not to keep bringing this up, but this is one of the reasons why I really like MCI, is that MCI, market conditions number, it helps to factor out this kind of like destination smooshing, origin smooshing that people do sometimes to try and make sure that the loads that they are posting on the board come up in the rankings, which they ought not to. Anyway.
Very interesting.
Yeah. So, but yeah, that number was definitely a lot higher than I was expecting.
Yeah, well, a lot lower than you were expecting.
Yeah. Yes.
Right.
Yeah.
Yeah.
So, All right. So what do we? I don't know if there's like technical issues. We're not getting questions or whatnot, or we're just people are busy pumping or filling up their fuel tanks. So I think we'll just move straight to plugs.
Yep.
So we have Matt's coming up, right? Mid-American Truck Show.
Yes.
We do. It's a
We'll
big
be
event.
there.
Yep.
We're sponsoring the Clay Walker Show. Dean will be driving the Grumpy Pete down.
Yep.
And that's going to cost you how much, Dean, each way?
About $1,000 each way, just in fuel. It's
going to cost DAT that much.
Right. It's a energy efficient Caterpillar engine. Anyone knows anything about Caterpillars, they'll know that they are not the best when it comes to fuel economy. I get about 6 miles per gallon empty loadable bobtail, so it doesn't make any difference to these big engines. But yes, it'll be an expensive trip, this one. Same as it was in 2014, the last time I showed my truck at Matt's. It should be a great event. We'll be there. We've got a lot of opportunities. We've got a big booth. We're speaking at a couple of sessions. We'll have a TV crew there. Be lots of opportunities to interview all of the different, some of the social media influencers we'll be talking to will be there. So it should be a great event.
Yeah.
And as always, we're on Landline Now tomorrow evening. Stephen Peddle will be on at 7 p.m. Eastern Wednesday night. I'll be on Radio Nemo again next week at 8 a.m. Eastern, channel 146 Road Dog.
Awesome. So I think with that, so we have TIA coming up as well. We'll be having tons of great talks there. I know there's some other things. I usually make a list, and I just didn't do that today. But
what Sales Chatter tomorrow with Dan Deegan and DJ Flores at 9 a.m.
I need to get back on that show with you, Dean.
Yeah.
We had planned to. I rewatched the episode, and it was just really fun. Yeah. It was really fun. Freight leads everything was kind of an interesting topic. But all right, so with that, we'll get in here under a half an hour and give everyone some time back in their morning. And we thank you for joining us, and we hope you have a great week. Stay safe out there. Bye.
Thank you.
Bye all.